Hello, this is Brian Rezny, President of Rezny Wealth Management, bringing you an important update about the economy and the investment markets. Well, it's probably, you've heard in the news about Silicon Valley Bank went under or taken over essentially by the FDIC. So let me talk about what that means. They had the classic run on the bank. While this bank had a lot of assets, well over $200 billion, and deposits around $180 billion, all of those assets are not readily available. They're lent out for homes and buildings and cars, things of that nature. So some depositors who had big deposits there had some kind of inkling or maybe heard some rumors that there were some issues at the bank. So they basically went in, withdrew millions and millions of dollars, hundreds of millions, some of these depositors, and essentially made the bank illiquid. So this is kind of the old wonderful life run on the bank scenario. The bank was solvent, meaning it had real assets to cover deposits, but it did not have liquidity. So when it ran out of money, they were forced to call the FDIC. The FDIC comes in, and of course the Treasury and the federal government did exactly the right thing, took over the bank like they're supposed to, a seamless transaction, guaranteed all the depositors up to $250 and even guaranteed the people above and beyond that, clearly because they know there's enough assets there to cover those bigger deposits. Now, why did this happen? Well, one of the things that supposedly Silicon Valley Bank required, that if you wanted a banking relationship or a lending relationship business-wise with that bank, they forced their depositors had to deposit all their money there. So, of course, you had people that had, $100 million, $200 million, $50 million of their capital, business capital there. And if they got a little nervous and pulled too much out, again, liquidity issue at that bank. This has happened before in the past. Smaller banks, of course, this bank is not really that big in the scheme of things. But generally speaking, it's been contained. Is there going to be spillover to other smaller banks? Potentially. And it would be if their depositors got a little nervous and a lot of people ran in and took the money out. Well, the Treasury, of course, has said we're backstopping. We'll make sure that the liquidity is there, FDIC insurance is covered. And remember, the vast majority of people out there are under the 250 limit. They would be covered regardless. This would really be bigger or smaller companies that had bigger deposits at this bank. We don't see this as a problem. But again, it's one of these things that pops up all the time. This is much different than when we had the financial crisis back in 2008, where Washington Mutual went out of business. Now, Washington Mutual, they had a lot of loans out against a lot of real estate that was worth a third of the value. So they had no assets. That was the problem. So when you have a bank like Washington Mutual out of business, they lent money on things that had no value. So they were really in a bad situation. Most of that really cannot occur today with new regulations that were put in place after 2008. And generally speaking, I would say the vast majority of banks are well capitalized because of these new rules and regulations, and that's not an issue. Again, everybody gets a little bit nervous. The world is not coming to an end. We see this being its way worked out as we go through the rest of this week. But again, remember, volatility is normal. Nobody likes it. We're not overly concerned, but of course, as always, we're watching things extremely close. And if we need to make adjustments, we will do so. If you have any questions about your portfolio, any concerns, please call the office. We always like talking to our clients. Make sure you have yourself a safe and profitable day.